Hello everyone, I'm Varun Venkatraman and I'm joined by my colleague Andrew Tam. We're both equity analysts at CFRA Research based in London. Today we're going to briefly cover some of our key observations from the fourth quarter 2021 results for the European market. Before we start, our discussion is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. So, Andrew, the last time we had a discussion after third quarter results, we were expecting a patchy recovery with mixed results within each sector. And I've definitely seen that play out in the stocks I cover. So it brings me to the first topic in today's discussion, sustained inflation and what that's done to margins. So it's been a case of sustained inflation leading to a mixed bag of results, especially margins in the industrial sector. What I'm seeing is that those that have pricing power have managed to pass on increased costs, while those that manufacture relatively commoditized products have really struggled and suffered margin erosion. Take, for example, Siemens. The automation and infrastructure related segments, which provide a sophisticated product, they've managed to maintain and even marginally grow their margin. On the other hand, the more commoditized rails business, still within Siemens, and the auto components business, they've actually lost a bit of margin. So it really does vary by the industry structure, the competitive advantages or lack thereof amongst the participants. As another example, if you look at the UK home builders, the four large ones we cover, Barratt, Berkeley, Persimmon and Taylor Wimpey. Now, despite sustained increases in cost of construction materials, due to a combination of hedging, bargaining power and some pricing power on homes sold, they've managed to maintain their margins. On the other hand, some of the smaller builders have really struggled and lost margins due to build cost inflation.
Yeah, hi everyone. Hi Varun. I think certainly your industrial names and some of my capital goods names, they've really been bellwethers in terms of seeing some of that high input cost inflation come through a lot earlier than some of, for example, the bulk of my consumer names. And whilst you might actually expect margins to be down as a result year on year, we've actually seen the reverse in some cases with operating margins actually higher than the prior year once you combine some of those price increases to pass on these costs along with some of the recovering top line trends that we've seen versus what was a disrupted 2020. You know, at the extreme end in terms of in the luxury goods space, you saw some pretty incredible sales momentum, for example, from LVMH. You know, they saw sales up 44% at a headline level, but it was still up 36% once you excluded the Tiffany acquisition. That's really due to the huge demand and combined with, you know, several rounds of price increases that went through during the year. And overall, that left operating margins up some 800 basis points higher than the prior year, which is absolutely incredible. I think one of the key questions that emerges out of this is whether companies, you know, on an ongoing basis are going to overplay their hand here in terms of some of the volume impact. In other words, what's that price elasticity, you know, in terms of their product and what the volume response might be from their customers.
Right, I guess that brings me to the next topic that I want to talk about. So is there a risk that demand is destroyed by inflation if, you know, it continues in this manner? And I think the answer to that entirely depends on the nature of the product and the demand-supply equilibrium within that market. This is where it can get really quite nuanced. Take, for instance, wind turbine manufacturers like Vestas Wind Systems. The sector has seen a strong resurgence in competition, especially out of China, where state-controlled manufacturers are partly subsidized. Now, if they can manage to undercut pricing from Vestas, that will definitely cost Vestas their revenue. Now, on the other hand, contrasting with that, I haven't seen any convincing evidence that revenue is likely to be severely impacted across the broader industrial sector, despite the relatively high levels of inflation. What has caused more of a disruption to revenue is supply chain breakdowns, and we've talked about this previously. Several industrial businesses which supply the automotive sector, like ABSKF or even Saint-Gobain, they've seen substantial volatility in revenue as production starts and stops at the large automakers. Now, within the home builders, as another contrasting example, it really depends on when houses become unaffordable, or rather if banks start tightening their mortgage lending. neither of which have appeared yet. So I think it's likely they'll get through quite unscathed.
Yeah, it's quite interesting. For me, meanwhile, in the consumer space, I think that's really a key question that we're seeing, particularly the beer brewers at the moment ponder. You know, Heineken and Carlsberg, they really saw strong sales rebounds in 2021. You know, as the bars and the restaurants reopened in that on-trade channel. But Heineken last week, they talked to costs per hectolitre rising in the mid-teen percentage points in 2022 as part of their guidance. And that's all with the cost hedging in place. So now you might expect a lot of those costs to be passed on, but the key question for investors, indeed management, really is what will be the impact on beer volumes given that broader cost of living squeeze on consumers at present. Again, at the other end of the spectrum, in the luxury names and the luxury space, we're seeing incredible insatiable demand there. And with that, probably higher than normal pricing power. You know, for some, it's almost as if these price increases actually make the good or the product even more of a status symbol. And when you overlay the fact that perhaps some of their target consumers, higher end target consumers, they've done a lot better than the average consumer throughout the pandemic, perhaps we won't see the same level of demand elasticity, and they'll prove a little bit more resilient or immune from some of those inflationary pressures experienced by the brewers. So on the face of it, whilst the inflationary pressures are a bit of a net negative, it's clear that they will impact different companies in different ways. For some, it'll be a headwind. For others, it'll prove a little bit more resilient. Ultimately, we think we're in for a period of heightened share price volatility, though, particularly as investors grapple with evaluations amid potentially a higher rate environment.
Yeah, excellent. That brings me to my third point, which I wanted to bring up. So what does this all mean for valuations, right? And I think it's safe to say that as a starting point, valuation dispersion has been less extreme across most European indices compared to the North American ones. Now, without getting too much into the detail of the broader market, European industrials, I would say, are trading as expected. And by that, I mean the cyclical names have worked their way through from being really quite cheap during COVID to more fairly priced, while the more defensive, high-quality names have managed to sustain their premium valuations even during the sell-off in 2020. So on the one hand, you have some sectors like home builders, and they look like they may even be undervalued. And I guess part of that has to do with the perception that house growth price may start to reverse at some point soon, which I think is quite likely. And on the other hand, you have some which trade more expensive, but I think ultimately they'll be able to get through the cycle without much variability in their top line. I think I would even go so far as to say a lot of the names that I research in Europe appear cheaper than their US counterparts. Broadly looking across the industrial sector in Europe, I would say valuations are not a concern as such at the moment.
Yeah, I probably agree with that. No doubt that the European markets, they've really not seen that as much of the PE rating and valuation dispersion that you've seen in the US, for example. Arguably, some markets such as the UK, which have really underperformed for several years, they could probably see a little bit more downside or valuation support. But certainly, we've seen within that an element of rotation back to some of the typical value names. For example, you know, with the prospect of higher rates, some of the more cash generative names trading at reasonable multiples, such as British American Tobacco, they've suddenly found favor again. You know, the share price up just about a third in just 3 months. And then that's, you know, with the prospect of buybacks on top of their extremely generous dividend yield, a bit of a cherry on top. And then at the other end of the spectrum, you've got, you know, the gaming names such as Entain and Flutter, which have a really quite attractive once in a generation growth opportunity ahead of them in terms of with the US market. But investors are seemingly discounting them to a degree, given the ongoing losses and the share price performance has been a bit more mixed as a result. Well, there you have it. It's clear that inflation is not just a one-way street, and companies will be impacted in different ways. At the end of the day, it really does come down to the strength of the company's business model that ultimately determines whether they can pass on some of these higher costs, maintain their profit margins and their earnings power. Whilst there's not much a company can do about the higher rate environment, the earnings power, both from a perspective of pricing and from their own cost base, it's the one thing that they do have some element of control over. Whilst the COVID-19 pandemic is far from over, it does feel like the recovery and the reopening is becoming less of a primary driver of share price performance from here, and other more intrinsic factors such as that pricing power and efficiency and balance sheet strength are once again coming to the fore. Thanks again for your time, Varun.
Thank you.